Good morning, everyone. My name is Jim Warner. I am the head of research at Lear Investment Management. Normally, I'm accompanied by one of our terrific sales guys, although they're all out selling right now, so that's a good sign. Um, there's the point of this monthly call, if this is your first time, is really to convey to you what we're seeing in the market, our interpretation of it, and then how we're positioning portfolios. So hopefully you come away with this having a better sense for what your clients or what you actually own yourselves. So that's what we're here for. There should be a Q&A button down at the bottom. Feel free as we go through I go through this presentation to jot down some questions. I'd love to take them on at the end. And again, this is for you to also better understand us. And so let me jump right in. And I normally do this by sharing my screen. All right. So today's presentation is called Maximum Greed, Minimal Fear. And what we mean by that is that there's obviously been a fairly overcooked market. Friday was an interesting sell-off, and we've sort of seen a reasonably volatile week thus far this week. But generally speaking, we had a really big run-up, particularly in AI names. And it had this sense of maximum greed. And there actually should be a lot of optimism, and we'll get into the difference between what overbought and overvalued means. But there's a lot of reasons to be optimistic about the economy, about the AI trade, and we'll get into all of those things here in a minute. The minimal fear is really how we feel about our portfolios right now, because we are still running with some excess cash and T-bills. So frankly, we'd love to see some dips in the market. And we also have done a really good job of trimming our winners, which have particularly been in the AI space that have seen a little bit of volatility here recently. So as we get into this presentation, I want to start at least level setting with where our performance is. I think that's a fair place to start. These are our main global vigilance strategies. We're on many different platforms, and most of these are available across them all. But Global Vigilance the moderate risk strategy, which is really our flagship, is up 9.4% for the year, which is beating the S&P and up 29.6% over the course of the last 12 months. These are all net of fees. And the part that we always point out that we're really proud of is the since inception of 9% annualized. That means that this is a great strategy to help compound wealth. Our tilt, which is the aggressive version of Global Vigilance, is up a little bit more, and it certainly had a really good run over the course of the last 3 years, which is essentially how long it's been around, actually 3 years. Global Vigilance, as you know, has been around for over a decade, as well as the conservative version, which also is having a really pretty good year, considering also that it carries a lot of fixed income, and the aggregate bond index, as you can see at the bottom, is basically flat for the year and has been flat really for the last 10 years. So great performance there. So, one of the things about this rally that has been interesting is that it's actually been right. It actually feels right, and I'll get into why. But the overbought nature that we saw, particularly last week, was a little bit worrisome, and so we had to deal with that in the short term. But the earnings are really doing all the work, and we'll get into that in a second. Then what I'll talk about is what is working, and we'll go into these three themes that we talk about, which is energy, AI, and industrial resurgence. And then we'll talk about what we're worried about. And lastly, the positioning of the portfolio, and then of course set some time to take your questions. So if we step back and look at what's going on in the market, it's very important to understand that the market is basically up. Let's just say it's roughly 10%, probably closer to 8 or 9, but it's up basically 10%, and all of it is reflective in the increase in the 2026 EPS estimates. So as we went into this year, the earnings estimates for this year for the S&P 500 was $291. That is actually now increased by roughly 10%. to $321. So this entire market move is all on the back of earnings revisions, which is a good thing. And that generally means that we're in a more durable form of a bull market. It's not risk-free, and we certainly can have pullbacks within that. But these earnings-driven rallies tend to be fairly stable. Now, they can, as we know, be unsettled by exogenous shocks. So we just went through one with the Iran conflict and the surge in oil prices. And we had one last year, of course, with the Liberation Day tariffs, the reciprocal tariffs. And so even within a bull market, you can have pullbacks, and that's normal and that's natural. And we're sort of going through that right now. Now, stepping behind the 10% increase in EPS, it's really been driven by essentially in three areas. Energy, which obviously oil prices have surged. We saw it in the CPI numbers, in fact, today. Information technology and communication services, basically tech. We've seen very powerful earnings, upward revisions there, and also in materials. And some of that is being driven by the fact that we have this industrial resurgence and manufacturing reshoring going on in this country. The rest of the market's been pretty blasé. In fact, one area of the market that's really kind of had a difficult time is healthcare. We'll go into healthcare a little bit more deeply later on because we actually think that's about there are some interesting healthcare names to own, and we'll talk about one in particular. Now, the one thing that has come up is the probability of a collapse, or are we in a bubble? And I think I've taken care of that last question of are we in a bubble by pointing out that bubbles aren't created by earnings going up. Now, maybe we're in an earnings bubble. That's generally rare, but it's something to consider. But no, generally bubbles are generated by massive expansion in multiples. Just people willing to pay more for the same amount of earnings than they did the day before, the month before, the year before. And we're not seeing that at all. So that gives me some comfort that we aren't in some sort of a bubble. And therefore, and what's going to make it crash? And I went back and I looked at sort of the four other times that, or really three other times that we've seen this kind of very rapid increase in the value of the overall market, which, by the way, of course, was led primarily by energy and then AI. And we've seen one crash one time, and that was in 1987, if you remember that, where essentially that was Black Friday, and essentially what happened was a whole bunch of portfolio insurance contracts, which don't exist anymore, had to get unwound, and that was triggered by a rate shock. But I think that brings up an interesting point, which is like, what do we need to watch to be, to be prepared and ready to see this thing coming? And the first is a rate shock. So that leads us to down the path of, do we have, is inflation going to be so bad that that's going to cause the Fed to raise rates significantly? And as we've talked about before, we think a lot of the inflation that we're seeing right now is frankly already in the rearview mirror. In fact, energy prices have already rolled over. They started in gasoline prices as well. And so we don't actually see oil being the driver of inflation. In fact, as we've talked about before, we see deflation in housing and other places. And honestly, there's actually basically zero inflation in core goods. So I think that takes the rate shock, worry, at least off the table for now. In 1987, there was this crazy technical liquidity trap that was created with these insurance contracts. We don't really have that. We don't have that at all. Are there other parts of the system where there's leverage and there could be forced unwinds? Yes, but we're really dealing with a much less levered world than we were before. And then I think the other key question is, have we seen a peak in earnings revisions? And honestly, I'm not sure we have. We're going to have to obviously wait and watch. right now is conference season, so we're listening to a lot of companies talk about how things are going, and we're not really hearing a lot of worries that would make us concerned that they might take down their 2026 guidance. But those are the things that we're keeping our eye on. So what is working? And I'll go back to the kind of the three areas where we've seen the biggest increases in earnings estimates. Obviously, the first one was energy that I showed you. And this is obviously being driven by the closure of the Strait of Hormuz. You know, that really doesn't affect the United States very much or the US economy very much. It's a much bigger deal for Asia and Europe. But that said, it actually is good for US oil and gas companies. And even this morning, we saw Devon Energy, a large exporter of oil, increase their production guidance because they're seeing incredible needs and demands elsewhere in the world. So that's actually a very good place to be invested. Interestingly, it's been a little bit of a tough place since the ceasefire, but we've actually added exposure to it because I believe that oil, much like gold was a great hedge last year and the year before, the new hedge in the market for portfolios is oil exposure. And obviously, you can get that through owning oil companies. Um, and so we've actually added to that. There was also an interesting statement that was made by, interestingly, executives at Chevron and Exxon about a week or two ago that warned that low oil storage levels globally could push Brent crude up to the 150 to $160 level. Now that would be probably pretty bad for the market, and therefore it's important to have exposure to companies that actually will benefit if that happens. So, who knows if that's just hyperbole, and if that actually will happen. It's very, very difficult to predict the short end of the, oil curve. But if you think about what's going on maybe next year and look out a year to 2027, what will oil prices be then? Well, the curve suggests right now that they'll be about $80, and that's of course a bit elevated still from where we used to be pre-war. And there's a decent chance, I think, that we actually could see higher oil prices than that, principally because of these comments about oil storages being very low and having to replenish them globally, as well as a lot of sovereign SPRs that need to get refilled. So. That's been something that we've recently added to the portfolio that we think gives us some comfort in this sort of scenario. The other big theme that we've talked about, of course, is AI and this incredible earnings flywheel that has really been spun up. Every metric you look at, whether it's token generation by businesses or you've heard about the incredible revenue growth at Anthropic this year. This industry is really just getting started, and I think it's going to be really fascinating when the Anthropic and OpenAI IPOs come to market, as we'll get obviously a lot more financial data where we can assess the health. But as we've talked about before, there's $850 billion or so of CapEx being spent on the build out of AI infrastructure and those models. Google last week came to market with a $50 billion equity offering and said in conjunction with that offering that CapEx is going to go even higher next year. So, the foundation for the AI trade, if you will, seems to be pretty well intact. And then the other theme that's really interesting and been driving performance is our industrial resurgence theme. So we've talked a lot in the past of how all this money that it went unspent, whether it was in the CHIPS Act or the infrastructure bill or the incentives baked into the big one big beautiful bill, or all of the pledges of reshoring that were made by foreign companies a year ago. This is the time when shovels are hitting the dirt. And so you're seeing a pickup in construction. You're seeing a pickup in manufacturing. And as you can see from the new orders, the chart on the left, being above 50 means growth. And Manufacturing orders have been in solid growth territory for the last, really for this entire year. And then if you look on the right, the book to bill for manufacturers is above one, which means that they have more demand than what they're supplying. And that means growth. And I think that because it's been consistent for the last, basically for the last 6 months, that's a very, very good sign that that theme will continue to work. And then the other interesting thing I wanted to show you today was the City Economic Surprise Index. Now, I've done this in the past and shown this chart. I don't wheel it out all the time, but what this measures is essentially this index goes up if economic data comes in better than what was forecasted by the street, and it goes lower when it's negative. And as you can see, this is an upward trending chart over the course of the last year, with the last month or two being actually pretty good. And this means that there's a level of pessimism in the market that hasn't been warranted, that the actual data, when it does come in, is actually better than expected. And so that's generally good for the market. And speaking of, strength, last Friday, which we got the non-farm payrolls from the government for the month of May, and they came in kind of at a shockingly high at 172,000 versus an 88,000 estimate. And that's so you can see on the chart on the left that it's been the labor market is pretty good. It's there's been some pretty solid strength there. Now, the one thing the market took from that was that, oh, we're going to have some overheating and therefore the Fed might have to hike rates in conjunction with the elevated inflation. And the market had a little bit of a reaction to that. Now, I will say that this 172 number is not totally genuine, and I think you're going to see it revised downward. For some reason, the local governments increased jobs nationwide by 50,000. So 50,000 of that 172 is from local governments. Now, the vast majority of local government jobs are public school teachers. And what seems weird to me is that in like the last or second to last month of school, you'd have this massive increase in teachers. It just doesn't seem to make a whole lot of sense. So there must be something going on. But the other interesting piece is that if you look at the average real weekly wage growth year over year, we actually got a negative reading in April. In fact, it actually another reading came out this morning, and it was also slightly negative. So that's not a good thing. When real wages are negative, that means that consumers aren't getting paid enough to keep up with inflation. The last time we saw negative numbers was obviously in 2021 slash 2022, and we had really high inflation. So we'd been in actually a pretty good spot for most of 2025, and now we've sort of seen it fall off as the headline. What's driving this is the headline CPI number contains the oil spike. This should actually start to reverse, but if it doesn't, that's a warning signal that we need to pay attention to. So speaking of worries, the consumers are unbelievably strong. The chart on the right shows you that the consumer is consistently month after month after month spending more, up to now $22 trillion, record highs in terms of personal consumption. However, and I think maybe some of this has to do with the higher oil prices, you've seen that consumers are having to dig out or having to tap their savings. So savings actually hit a kind of new low in recent times at 612 billion. Now, don't forget that there's also still $8 trillion of cash sitting in money markets, but this is a little bit concerning, particularly for the lower end consumer that we need to obviously continue to monitor. So if you put together the strong payrolls and then the negative real wages and then the elevated inflation, which I think we're going to start to see inflation come down as oil prices come down. Um, you have now this sentiment that the Fed may actually need to hike rates. And if you looked, I looked this morning at the Fed futures forward curve, and right now there is a probability is there's a strong probability that the Fed will have to raise rates 25 basis points in either the December or January meeting. Now, obviously, that's some time from now, and a lot can change. But we have to keep a close eye on that and a close eye on what's going on with the 2-year yield because that is starting to price in some of these higher inflation expectations. Now, interestingly, though, the 10-year Treasury is really barely budged. And so this is really more the market saying, we see this Iran conflict creating this sort of short period of inflation in the near term, and the Fed may have to react to that, but we don't think this is going to last forever. And so that's essentially what the market is saying. Now, how are we positioning for this? Well, as my father liked to tell me, he loved to quote this old Wall Street adage, which is pigs get fed, but hogs get slaughtered. And so we've taken that to heart. And we've spent, we started probably a couple months ago trimming back on some of our AI related names that had had a tremendous run, but they had gotten to a point where they were technically overbought. Now, this doesn't mean we think they're overvalued. And I'll show you an interesting chart here in a second, but the fundamentals are still outstanding. But you have to be aware when you're a portfolio manager of crowdedness, and it can take very little, like a slightly hot payroll print on Friday, to get a big blow off in the market and in these AI names. So we've already trimmed back most of our winners back to neutral weights, and so that impacts us less. Partly because we sort of saw this coming. It eventually happens at some point. But that being said, we haven't really changed our fundamentally optimistic and positive view on some of these crowded AI names. The one that has obviously been one of our biggest winner this year has been Micron. We bought it exactly a year ago. It's up over 700%. It's obviously gotten very volatile, but ironically, it's actually cheaper today on a forward PE than it was when we bought it. So the PE's actually dropped from 9.7 times to 9.1 times because earnings estimates have gone up 780%. So the entire move in Micron is based on actual earnings that are expected. And considering that they basically are sold out for the next year, these are actually probably pretty reliable numbers. Now, it's anybody's guess as to what the number what happens to the number in 2028, because there's going to be some new capacity coming online, and that could soften up some DRAM prices. Of course, that'll be somewhat offset by the higher volumes, but it certainly is a stock that is being driven by earnings and not by just bloated expectations. And this is essentially the same point that I made earlier on the S&P itself. It's up roughly 10%, and that's basically entirely driven by the higher earnings estimates. So what have we been doing? As I've mentioned, we've been trimming our AI winners. In fact, many of these had, because of the growth, because of the appreciation, we've had to really trim them back for important risk management reasons because they had gotten too big. And so, we're also always we're always trimming names where they get crowded or there's overly bullishness. So what are we holding and adding? We still love the electrification and power thesis. This is the binding constraint of the AI build out. As most all of you know, a lot of these AI data centers are now having to build out their own electricity generation. You can't just tap into the grid. That's become politically unpalatable in some locations. And that's caused enormous, demand for, for generators and all the various different things that are required for electricity generation. We've also expanded our thoughts on AI down to the level of specialty chemicals and gases. This is the foundation layer of the stack. If you haven't heard about the Jensen Huang's GPU stack, I suggest you Google it or throw it into AI. There's a great image that is produced that shows all the various different layers of AI and what's being impacted. But at the very bottom and at the core of any of these chips are these specialty chemicals, and there frankly aren't that many public stocks that participate in that market. And so we've added one, and we think right now it's just completely overlooked by the market. The golden age of healthcare, we've been talking about this theme for some while, and honestly, we've had some fits and false starts on this one. But I'm about to share with you one name that we just added to portfolios that we're really excited about because really the drug discovery process could go through a radical change with the application of AI. In fact, there's some indications that some companies have found that they've taken like one drug that didn't work for solving this particular disease and combined it with another drug that also failed at whatever they were trying to accomplish, but you put them together and they can solve some new disease. So it's really exciting, and I think that's where we need to be headed as we sort of play this AI wave as it rolls through industry. We want to be in the places where you're seeing just incredible productivity being generated by AI, and I think the pharmaceutical industry is about to go through a pretty remarkable period. We've already talked about industrial and reshoring beneficiaries, but we think we're still early innings there. We've remained in short duration credit primarily, and we have probably a little bit more cash than we normally have. So that's somewhat of a hedge to given the amount of volatility, and thankfully it hasn't impacted our performance really at all. And then lastly, I mentioned the oil hedge, which we think is, important for all portfolios at this point. So the healthcare name or the pharmaceutical name that we have added that we think is, and we added this on a dip, is Eli Lilly. Now, a lot of you know all about this, but we think it's really in a remarkable place with a whole bunch of catalysts that are coming up with the oral pill form of the GLP-1 drug, as well as the partnership that they recently announced with NVIDIA to build an AI-based lab that hopefully will, shorten development cycles and hopefully compound into structurally higher R&D returns. So just to go back and reiterate, the three key things that we're looking for is, a peak in earnings revisions, broadly speaking, real rates and the 2-year, and then of course whatever resolution or escalation happens in the Strait of Hormuz. I don't think anybody has any edge on that. We're pretty happy right now sticking around with a high teens % of cash and T-bills. And if there's a pullback, we'll take advantage of it. So let's end there and see if you guys have any questions. I'd love to talk about it. I'm going to stop my screen share for that. All right. So the first one is, what is your feeling on Social Security? Lots of clients rely on this income. Will the government be able to fund out or modify payments? Well, apparently, there was a news report out recently that Social Security may go insolvent in 2032, and I think at midnight on the day before it goes insolvent is when we will actually get a solution because politically no one's going to touch it. So the answer is I have no idea, but they will find a way to bail it out at some point, I would imagine. But it won't happen until the very last minute, is my guess. And so, yeah, it'll probably create a bit of panic. Congress has a way of doing that, but we'll see what happens. It's probably not going to get touched until that time. The next question is early in the year, tech and commodities seem to be correlated. That seems to have changed in the last couple of months. What do you expect of the coming months? Well, it's really I actually don't. The correlation really wasn't between tech and commodities. The correlation was really an inverse correlation that commodities have to oil and interest rates. That's really what's been going on. You had obviously coming into this year, and which commodities are we talking about? We're talking about gold and silver. Those basically have this sort of inverse correlation going on. Other commodities, I'm not going to touch, but we talked about oil. That's operating on its own, you know, uh, uh, schedule essentially with the Iran conflict. Um, but yeah, tech itself, I think, is really more correlated to risk taking. And so we went through a period at the end of last year where there was a lot of risk taking, then there was a pause. And remember what we talked about at that time is that they got really crowded. And so you had a sell-off, and then people revisited AI as soon as essentially the Iran conflict started because they should be able that trend should be able to power through higher oil prices. Um, so I actually think that the two have actually operated into a little bit independent from each other. So the next question is, if in your pairing of gains, do you take into consideration whether they're long term or short term? Yeah, great question. We're really, really sensitive to taxes. We don't have a single client that likes to pay taxes, so we get it. And we think long and hard when we're trimming what this is going to do, how we're going to message it, and that sort of thing. I don't have any clients that get angry with me for taking short-term gains on a name that's up 700%. But we don't like to take them, honestly. We do it from a risk standpoint because it got too large. We had to do this last year too with Iran. But it's something that we really try to avoid. Now, we also try to we try to harvest tax losses throughout the year. This isn't like something that we do like in December. We do it throughout the year. And so if you've been watching our trading closely, you'll see that we actually will oftentimes pair capturing some short-term gains with capturing some short-term losses. So good question. We're very sensitive to it because we know you all are as well. SpaceX. Okay. So, and I'll pair this with the next question, which is how do you think SpaceX will affect AI? Um, yeah. So look, SpaceX is a really special company. It's been around for 24 years. It's got a very, very profitable space transportation business. It also has Starlink. It also has XAI, which is probably running at a big loss. But basically, it's a very interesting company. But come on, folks, it's trading. They want to go out at a price. It's 200 times revenue. That's insane. And I went back and did some work on other very, very big time IPOs, and oftentimes they will spike and then they'll go down 50%. So, but we're keeping in general, we don't invest in IPOs. We want to make sure that a stock has time to, kind of mature in the public markets, have a couple of earnings calls, get a better sense for how it's going to trade, who's in it, that sort of thing. But it's a really special company, and it's something that obviously is eventually going to get added to the S&P 500. It's already going to get added to the NASDAQ 100. So a lot of people are going to, own it indirectly through ETFs. So yeah, I mean, it's something that we're going to watch real closely. My guess is we will get a really good chance to buy it cheaper at some point. But it is obviously got an enormous total addressable market. I mean, like your brain can go bananas on this one because you're like, okay, robots on Mars building a civilization and data centers in space, and that seems more likely. But these are all like things that are going to happen 10 years from now. And so it's very hard to discount that back to present value and and know that you have some measure of margin of safety. Yeah, so that's my basic thought on that. I mean, to tie that effect on AI, I mean, look, it's just AI is just going to grow whether SpaceX or not. They're obviously going to grow it. Elon's got the ability to do this in space. That could be a huge advantage. But everyone is going, this AI trend is real. It's happening whether SpaceX goes public or not. Remember, I mean, SpaceX has been around a long time. It's like, it's not even really like going public. I mean, there's been so much trading already in this stock in the private markets that, it's just a very different IPO. And obviously it's a very, very large company. Um, the next question actually is an interesting one. What are our observations and thoughts on SaaS companies? And are we watching any names in the space? Yeah, we started actually we actually started buying in some portfolios, but not widespread. Salesforce. We've frankly, I personally have done a lot of coding in using Claude, and nothing I am going to create is going to ever measure up to enterprise level software. And that's effectively what you're dealing with a Salesforce or a ServiceNow. They have incredible business models. They have subscription services with very little churn. That's the key metric I would continue to watch if people are able to essentially copy what they've done. But they also have the ability to react to and include AI as well. So, if you're trying, excuse me, trying to develop a competing AI product, um, Salesforce is already doing that with their own products. They're already kind of integrating it. So I think there are definitely some interesting things. Now, obviously, sentiment is really, really negative on the space broadly speaking. But I think to some extent we're at a point now, valuations have gotten so cheap that you can take a flyer on a really great company like a Salesforce. So that's all I have for questions. I don't know if anybody's got any more, but I think we've touched on a lot of great topics. You know how to find us. We will be distributing a replay of this in the next couple of days. I'll have the presentation attached. Um, our phone number's in the back, and feel free to contact us. We'd love to hear from you. And if you have any more questions, obviously, feel free to reach out. So with that, I'll end it here. Thanks for joining, and we'll talk to you next time. Take care.